In the previous videos, we have seen how emergency corpuses can be created. Independently, we have also seen how STP or systematic transfer plans work. Is it possible for us to combine both the emergency corpus and STP for a superlative return? I think so. And let's look at how we can do that. The process of doing that is called Capital Appreciation Systematic Transfer Plan, or Capital Appreciation STP in short. Now let's see how a Capital Appreciation STP works. STP refers to Systematic Transfer Plan, that is transferring of a certain amount of money on a periodic basis from one scheme to another. That's what STP means. What does it involve? It involves two schemes, one scheme being the source scheme, the other being the target scheme to which the money flows. How does it flow? It can be weekly, it can be daily, it can be monthly, it can be in any periodicity that you may decide. Who is this for? STP is typically used by people who want to take advantage of either being conservative or who want to take advantage of market volatility. So either you move from debt to equity or equity to debt, depending on what your need is. In the current case, what we are exploring of Capital Appreciation STP, it will be funds that will move from debt to equity. Now let's look at what is an emergency corpus. As we have looked at, emergency corpus is nothing but funds that you keep separately at a given place. It can even be a bank fixed deposit or any of that thing, where you generate a very, very small return. In fact, return is actually not the reason why you keep money in emergency corpus. You keep it so that if there is a need for you, say an instance of loss of job or for any other purpose, if you need to access some money, you don't need to touch your core investments that are in the stock market. You have this corpus that can provide. Usually it refers to at least a 6 month of your monthly expenses that is kept somewhere separately. But one of the problems that emergency corpuses suffer is that they offer very, very low rate of return. You can't keep it in savings account because you may spend it. You have to necessarily move it a little away from that into an FD in a bank. Unfortunately, the banks are very, very low rate of return and there is high taxation. Therefore, that may not be the most appropriate. Therefore, you look at the other option, it could be a liquid fund in a mutual fund, which is a non-equity product which provides quick liquidity as and when you need it. Liquid funds are a great choice for this. But even the liquid fund is only a 7% return at most. What do you do, especially if you're going to keep this money as an emergency corpus over a slightly longer period? Here is where we took an example and really worked out a real life case. Let's say somebody has a 50,000 rupee monthly cash requirement. Therefore, his 6-month emergency corpus is an amount of 3 lakhs. And let's say he wants to start from 1st January 2025. Then for him to create this 3 lakhs, he would require a monthly contribution of 11,000 rupees at a nominal rate of 7%. If he were to keep investing 11,682 rupees every month in the next 24 months, assuming the rate of return is 7%, he would have created a 3 lakh corpus. Once he has created a 3 lakh corpus, this is where one can activate the STP. Now this 3 lakh corpus in a liquid fund is available to you for any emergency needs, but it is only yielding 7%. That 7% works out to roughly about 20,000 plus. And if you do a monthly calculation, it works out to about 1,750 rupees. While the 3 lakhs needs to be safe at all times, the 1,750 rupees that you can pull out from the scheme on a month-on-month basis can go into something a little bit more aggressive as an equity mutual fund. So you can therefore start a systematic transfer plan into an equity mutual fund and continue that going on a month-on-month basis. What this means is at the end of the day, corpus is going to remain 3 lakhs, but incremental gains in that corpus will keep moving into an equity fund. At 1,750 rupees going into an equity fund, which is highly risky, but if you did continue it for a period of say 10 years, then that itself will give you a corpus of about 4 lakhs plus, on the assumption that the SIP is giving you a very, very nominal rate of even 12%. So here is how you can combine the safety of an emergency corpus together with creating some real value without really compromising the corpus. That's really the point, and that's where this capital appreciation STP comes into play, because what that does is that it's never going to touch your principal. It's only going to skim the gains and then move it into an equity fund. It's a great product, especially for somebody who wants to be very, very safe, wants to be literally risk-free with their initial corpus. This is a scheme that's made for them. In our example, we have taken a much smaller amount, but as that amount keeps growing, instead of 3 lakhs, if this amount is 30 lakhs, then imagine the gains that you will make at the end of the day is quite substantial. So it's something that you should look for, especially if you are more conservative and you want to play it safe. The combining of emergency corpus and doing an STP from that into an equity scheme to really bolster that corpus in the long run may be something that you ought to consider.